We're joined now by Mike Estment, who is CEO of NFB, for a look at some investment strategy. Hi, Mike.
Good afternoon to you.
Let's look at the bigger picture here. Every day we report on the currency and the rand. It's been weakening. Let's step back a bit from the daily reports of these things, and people get excited depending on where they stand. If you export, you want a weaker rand. Of course, if you don't want to import inflation, you want a stronger rand. Taking that step back from an investment point of view, how do you see it?
Well, the rand has been a currency that's historically shown quite significant volatility. We had the rand run out some years ago where everyone was fearful of a 20 rand to the dollar number. When it got to 13 and even worse, they were exporting currency as individuals. I think in a corporate market, less so. But it's also true when one looks at the currency, you need to understand that the trading for commercial purposes in the rand compared to global trade in the rand are two very, very different figures. An expert in discussing this with him sort of suggested that far in excess of half of the trading in the rand is not ever seen or dealt with onshore. It's done between hedge funds or two commodity or currency or investment managers globally. And it is a very highly sophisticated market, a very developed market. So the rand is something which will be moved about because of that liquidity and sophistication of our market, maybe sometimes unnecessarily so.
In a way, it's a kind of compliment that we are sophisticated, that it's liquid, that people can do it.
Indeed it is, and in both in terms of our banking setup, our electronics and infrastructure in the IT sector, the JSE as an example, our accounting processes, they are world leaders, and that is a double-edged sword, exactly as you say.
How should it affect one's thinking? Because people do tend to panic. I mean, even though you keep being told take a long view, you were recalling of the 20, I think it was 20 rand to the pound and 13 to the dollar. Right. And people were saying, well, it's never, ever going to get stronger. In fact, it's going to get weaker. And they were saying it in the way that you say the sun's coming up tomorrow morning. So, and that's experienced, educated, intelligent people who get into that herd mentality. Yeah. How do you make sure that the investment strategy resists that herd mentality?
You put it in the hands of professionals. But those professionals are indeed some of the experts you spoke of a second ago. So you really have to sort of say, what's the long-term need? What's the logic? And if an investment is tactical, and you're trading it, in other words, you're going into a non-South African currency so that you can exploit the weakness of the rand, then that's tactical and that's short term. If it's a strategic investment where in a family environment, an investor environment, you're saying in the long term it makes sense for us to diversify across geographies, currencies, and indeed the underlying shares, stocks, and investments, property and other that you can make in that other currency, then the rand, to diversify away from the rand, makes sense.
Do you think there'll be any response to the calls which we hear every now and then about we must weaken the rand? And the response, of course, is, well, it's very difficult because a lot of it's out of our control.
Yeah, I think that in many central banks and governments have tried that in the past. There are corpses that litter that particular path.
And whether they're trying to weaken or strengthen it.
The market's bigger than the currency. It's not about commercial trade, it's about the market taking positions, and the market's a very, very big place.
Let's move on to inflation and the effect on investment. And you told me before you came in that you had very interesting numbers there. And of course, we think of inflation, again, we are short term. We think 5%, 6%, 7%. We don't look at the cumulative effect of that over the years. So what are your findings there and how that affects your investment approach?
Well, David, if you look at some of those, the items that I shared with you, like school fees, like the price of petrol, a simple thing like a packet of detergent washing up or clothes detergent, they've gone up in excess in some cases of 250%.
Over what period?
Over 10 years, and in some cases over 100% in that 10-year period. What is critically important, if you just said that a litre of petrol would cost 2.5, almost 3 times as much in 10 years' time, you better be investing in assets that keep track with that. Alternatively, by not making that decision and taking the risk that is afforded that position by the very nature of the price variance of shares and properties and other growth assets, you're taking a different risk. You're taking an almost certain risk that you can't keep track with the buying power of your current portfolio.
But that kind of increase, if you're looking at 250%, 200% increases, there are not too many investments that are going to be reasonably sure of given that.
Exactly. I think the compounding nature of, look, that's also, you know, you don't spend 100% of your budget on a pack of washing liquid or on petrol.
So you work out
It's
how
small
much you like
percentages. And that's indeed where the inflation basket comes from. So a typical inflation basket would include fundamental foodstuffs, rent and electricity, interest, and those sorts of issues that everyone is exposed to. The more exotic you go, the more you sort of say, well, I really like a single malt whiskey. If the currency gets hammered and there's inflation in the economy, you're going to pay dearly for that, and you'll probably have to have a drammy or two less next weekend.
Well, two areas, currency and inflation, where we do tend to look at the short-term numbers, but you need to look at the long-term ones. So I think that's clear from Mike Estment, CEO of NFB.